James Mitchell. I'm the CEO and founder of Strategic Blue. We're here at Cloudscape 7 talking about cloud computing and how the European Commission is helping to foster a more vibrant cloud computing market in Europe. Was on a panel earlier on today discussing how cloud computing is seen by many as a commodity, or at least tradable as a commodity. I have a particular background in this. I have a background in commodities trading at Morgan Stanley. Not the kind of exchange trading where everything is forced to be a fungible commodity somewhat artificially, but rather someone who would go out and buy physical power stations with all of its environmental liabilities and big piles of coal, and very much not the sort of things which are fundamentally interchangeable. About 5 years ago I moved across into the IT sector with a view to bringing across the trading and pricing and risk management expertise that I'm so used to with in the commodities world, and applying it to cloud computing. I have to say it's been quite a steep learning curve, but I still generally win the debate about whether or not electricity is a good analogy for cloud computing, and it covers about 90% of the key aspects of cloud computing, and then where it breaks down, I'm able to draw from other commodities, like take coal for example. Coal is very much not the same when you dig it out of the ground in different parts of the world, in the same way as an instance or a virtual machine from a cloud provider is very different depending upon the way that it's been provisioned by different cloud providers. There is nevertheless a very healthy traded market in coal, and it is based around a quality benchmark, inconveniently known as API, the Argus Pricing Index, for standard or perfect, if you like, coal that has a particular energy content, ash content, moisture content, sulfur content, and there's like an independent assayist who, when a cargo changes hands between a buyer and a seller, they go on board and they actually measure what has been delivered independently, and there is like a truing up of the value of this, depending upon if it has a higher energy content, then you'll pay a premium for it. If there's got a higher sulfur content, that's bad, and so there's a discount from it. And I believe that a similar methodology can be applied in order to create relative value metrics and benchmarking between different cloud services. The point being that the majority of particular infrastructure services are based on common underlying technologies such as CPU, RAM, storage, and the pricing from different providers for kind of similar products. It should be mutually consistent and make sense, and I believe that if that happens, there's going to be the opportunity to use some of the financing techniques which are common in, for example, the electricity industry, where you don't need to fund the build out of a power station with 100% equity. You're able to do, say, 20% equity and 80% debt. That will drive, that has driven down the cost of financing power stations. I believe the same thing can be done for the build out of cloud services.
If you look at the commodities and trading thereof, I think the Deutsche Börse has tried to do something like that, to create an exchange for cloud computing. What's your vision about that?
So there's kind of two types of exchanges in the world. There's like a telephone exchange and there's a financial exchange, and the two are very different. What a telephone exchange does is it provides a way of literally physically making a connection between a buyer and a seller. There are aspects of that to what the Deutsche Börse are talking about. That may well be a precursor to the financial side, which would make sense, seeing as the Deutsche Börse elsewhere is very big in electricity trading, and they're not doing the physical connecting up of the electricity wires. Where a financial exchange comes in, they basically offer their services to an already formed over-the-counter traded market where there are bilateral contracts between traders of a particular commodity. The exchange itself doesn't take any risk. All it's doing is finding willing buyers and sellers who have to be willing simultaneously to enter into a contract with the exchange, and it is simply a way of reducing the overall costs of trading between sophisticated counterparties. It is not normal for end users to, or even end providers in many cases, to interact directly with an exchange, because the financial exchange has to remain risk-free, and so you have to post collateral, which requires a very low cost of capital to be able to finance this. And so even a big hedge fund, for example, generally wouldn't interact directly with an exchange. It would go through a prime broker, which is generally owned by a bank, who then manages the collateral on behalf of a range of clients. So these exchanges are generally services which are offered to traders. Once they're trading with one another, they then publish a transparent price, which is then seen by end users and is used as a metric for whether or not the price that they pay at the retail level should be going up or down.
If you look at the let's say the commodities, if you look at your example with coal, the basic thing there is the energy content. I think you want to have to get the energy out, and the better you can do that. But so there's a clear value there, and then there are things which are bluttering it more or less. In cloud computing, do you think that's the same case, or is it? I mean, yesterday Apple announced a new MacBook, which means that the value of all the other MacBooks just goes down the drain, to say the least. I mean, there is and if you look at the things that are in the cloud, then you have machines with GPUs, machines without GPUs, with two GPUs, with high speed networks, with low speed networks. There's so many differences, and they're so. Is it something that you only see as differences because you look too much detail, or is there some kind of general content?
So the area that I care about is looking at, I mean, at the moment, as Strategic Blue, our company, we quite literally trade thousands of different cloud services, and we set prices for them on behalf of our customers. Something that would frankly help us out tremendously is finding customers, and we do have certain ones who are able to do this, who regard different instance types as fungible, different regions or availability zones as interchangeable for their particular application. And what that allows us to do is, internally, when we're managing our risk for that, we can basically couple the prices of these together. So in order to create a market, what you require is enough people that regard multiple resources as interchangeable. With some, you might need 2 of these for each one of that, but if it is more than half as cheap, then it's good to move from one to the other. If you have enough people who are able and willing to do that, and either doing it themselves in a sophisticated manner, or alternatively have passed that flexibility to a trader who is very focused on the pricing and the monetizing of those basically options, then you end up with the supply-demand characteristics for capacity management of one resource, one cloud resource, then affecting the other one, because people can follow prices as a reason to move from one to the other. And this is a very similar problem to trying to balance the grid across Europe, for example. There are pricing signals that get traders to buy cheap wind power when it's very windy in Denmark, ship it across the border into Germany, ship it across the border into France, ship it through a DC interconnector with significant losses into the UK, and that turns off diesel gen plants. So when we say it's very complicated in cloud computing, you need to know enough about the particular commodity that you're comparing it to and the level of detail there. There's been an awful lot of market structure and technology, albeit generally physical technology, that has been applied to the world of electricity in order to make people feel that it is more simple than cloud computing. It really isn't. It just has different complications.
Yeah, there is, of course, in electricity, it's the content. The basic content is the electrons. In coal, it's you could say the energy. But is there something underneath that you could say, well, we are in the business of trading, not energy or electricity, but something.
Some unit. Yeah, wouldn't it be lovely, like an SI unit for cloud computing?
Yeah.
There are various organisations that are kind of trying to do that. So IEEE are looking at that. There's a company called Six Fusion who are doing that.
Yeah.
I don't know whether you'll end up with just one. I mean, if you look at oil, there's West Texas Intermediate and there's Brent. So first of all, we ended up with two major ones, not one.
Yeah.
And the other point to note is the vast majority of the oil that comes out of the ground today bears no resemblance to either Brent crude or to West Texas. It's miles off spec. They probably ought to rebase it soon, but the oil market continues to work to good effect, and it would be very nice to see those kind of independent benchmarks be brought forward, because Strategic Blue as one company would very much like to trade around them.
Yeah, our magazine is also a lot about high performance computing, and there you have typically lots of benchmarks which are used. And for instance, you have the Linpack benchmark, which is used to classify the top 500 machines, and then everybody who's on the list agrees it's a very good benchmark. Everybody who's not on the list says it's not a good benchmark. So there's a lot of difficulty there. So it could also be, of course, that it's just because people like to have a scale with numbers which is easy to understand. That's the main reason.
Yeah, so this is the challenge in terms of trying to do this well. I mean, in the sort of cloud world, there's no reason why you can't have quite a large number of benchmarks, provided you would like to have the ability to do reference pricing in between them.
Yeah.
And the general aim here is to have one master benchmark, if you will, where either another benchmark or an actual service from a specific provider. The key thing is that you want the rate of change of the difference between the main benchmark and what you're specifically looking at. You want that to vary slowly compared to the benchmark. And so long as you're able to make that happen, you can essentially use the main benchmark as a means of proxy hedging the future price risk you have, because you haven't already locked in a contract for what you're actually going to use.
Yeah.
So if you take an extreme example of this, I noted that a little while ago the Russians entered into an agreement with the Chinese to build a pipeline from Russia's gas fields to China as a new market, and they agreed an index price for the price of that gas. The index they chose was the price of crude oil.
Yeah.
Even though it's got nothing to do with, oil and gas are fundamentally different.
Yeah.
That is what they chose because the price for gas follows the price for oil. And it's not because you make gas from oil. It's because lots of contracts for gas are written on the price of oil, because oil is a more, Brent crude, say, is a much more liquid contract, and so you're able to hedge more easily. So you end up with this self-fulfilling prophecy that because everyone hedges using Brent crude, even when it's natural gas, it continues to work.
In your company, what you do is this kind of marketplace, this kind of trading. Is that what you do?
So Strategic Blue has two core services. We have our cloud options service, which is basically a service for end customers of cloud computing. So take Amazon Web Services customers, for example. We will offer to step into the billing chain between a customer and Amazon, and we will fix three issues, or three types of issue. The first is billing. So because we're in the billing chain, we can choose and agree the terms under which we bill the customer. So we can get rid of credit cards, we can change the currency, we can send them their invoice before the end of the usage month, instead of a few days later. All of those procurement issues. The second one is finance issues. You get this huge discount if you pay upfront for 1 year, and an even bigger one if you pay upfront for 3 years. That can really mess with cost allocation problems, not to mention cash flow and the fact that a CTO sold to the CFO that the move to the cloud would move CapEx to OpEx. If you prepay, it kind of looks like it's moving it back again. Yeah. And so there tends to be a reluctance to make these long-term commitments to the customer. Those long-term commitments are crucial for cloud providers so that they can do capacity planning, and that's the reason why they offer a discount that is deeper than their expectation of dropping on-demand prices. So in general, it should always make sense to pre-commit if you are able to make a pre-commitment. So we basically intermediate that. We'll pay the cloud provider, we'll secure a long-term contract from the customer. It may not exactly match. For example, we might get an 8-month deal from the customer and then buy 12 months from a cloud provider. We will then take the pricing risk on, say, the back 4 months. That means that we build up a book of risk. We have value at risk limits and all of the things that you'd expect from people with a background in trading, backed by hedges and former traders. In order to manage that risk, we have basically developed some pretty deep expertise in the price of cloud services, obviously particularly Amazon, but we're looking at Azure and Google, etc. as well. Our second service is now making those insights, those pricing insights, available as a service of the same name, Pricing Insights, where we basically share the way that we look at historical data and the way that we look at any data that we have on forward pricing, and basically help cloud buyers, cloud resellers, cloud providers to understand where the prices might go and how they can appropriately look at pricing data and use that to draw insights in terms of their own pricing risks.